The UK economy showed more signs of slowing down, with the slowest quarterly growth since the mini-recession of 2023. Growth actually fell in September after a flat August. It means that in 2025, there's only been positive growth in 3 of the 10 months so far. Adjusted for population, real GDP per capita is even more disappointed, with a continued stagnation, real GDP per capita failing to recapture even the pre-COVID peaks. Now, the ONS stated a key reason for the negative growth was last month's cyber attacks on Jaguar Land Rover, which contributed to a big fall in industrial production and car production in particular. There was also a fall in pharmaceuticals, which does tend to be a bit more erratic. However, despite these temporary excuses, you could say, there are signs that consumers and businesses are holding back due to both deteriorating circumstances and the anticipation of the upcoming budget. Now, earlier this week, there was more bad news with unemployment jumping to 5%. Now, you may say that by historical standards, this is actually quite low. But if we look closer at levels of underemployment, that's people wanting to work more hours than they're doing at the moment. This is rising close to levels last seen in a post-financial crash recession. And it does indicate a continued squeeze in living standards. And of course, at the same time as people wanting to work more hours, another problem is people leaving the labour force due to rising inactivity due to health conditions. The growth in GDP last quarter was mainly driven by investment, which is at least one area of the economy that desperately needs boosting, with many of the UK's problems at least partly attributable to low investment in recent years. Though it is something of a circular argument, in that firms claim they are reluctant to invest because the economy is weak, profit margins very low, and breaking that cycle is a difficult challenge. The government have marginally increased public sector investment by relaxing borrowing rules, but it is not boosting investment sufficiently to make a material difference to economic growth. And if we look at the consumption side of GDP, the big driver is compensation of employers. It is up 8.3% over the last 12 months. Now, if you're a worker, an employer, you may be mystified about this big boost in employer compensation. But what actually is happening is that employer contributions include all the tax rises, the national insurance contributions, which rose 4.3% compared to the rise in wages of 0.8%. Another area of weakness in the UK economy has been the export sector, and this shows the deterioration in exports to the EU from around 17 billion in 2022 to 15 billion in 2025. And it's not just Brexit-related difficulties, with exports to non-EU countries also falling by a similar amount. It means that despite weak growth, low spending, the UK's current account deficit is around 3% of GDP. This means the value of imports of goods and services is greater than our exports. And what that means is that you need to be able to buy these goods and services by attracting capital flows. Basically, this means things such as American firms buying British firms, or Gulf states buying up property in London, or foreign investors buying British bonds to fund the UK budget deficit. So to buy these imports, we need foreigners to lend us money in a different way. Now, a current account deficit isn't necessarily a bad thing. We've certainly had one for a long time, but it does reflect a long-term weakness in manufacturing export capacity, and also the fact that many assets have been sold to foreign buyers, and that means in the long term a stream of dividends and income leaving the economy. Now, what about the housing market? Because of slowing economic momentum and budget speculation, it's also having a negative impact on the housing market. Since a mini crash in 2022, house prices have recovered in nominal terms, but are now starting to flatten out. However, the latest survey from RICS shows tentative signs of house prices actually falling. Excluding Northern Ireland and Wales, prices are falling in most regions in the past 3 months. This RICS survey tends to be a more up-to-date snapshot of what is happening in the housing market right now, rather than other price indexes, which can take longer time to produce. Now, whatever the prospect of future house prices, there does seem to be a clear wariness of entering the housing market at the moment. New buyer inquiries have fallen, and the big question is how much of this is driven by pre-budget nerves and how much is driven by larger fundamentals in the economy. An optimistic take would be that people are just waiting to see what happens in the budget. There's been so much speculation about potential new taxes on the housing market. Many people may just prefer to wait and see. Now, I actually think that housing taxes will change by less than some fear. I can't see any rise on most households, although nor do I see a big cut in stamp duty, beloved of economists and housing experts. However, on the other side, a pessimistic take is that the weakening economy and rising unemployment suggests that the housing market will once again be squeezed, as high rates of unaffordability, don't forget, still pretty near historical high levels, plus that declining confidence makes households wary of taking out a big mortgage. Now, on the housing market, at least, I'm a little less pessimistic. A slowing economy is likely to enable the Bank of England to cut interest rates. Mortgage rates have already been falling in recent years, and rates could fall even further in the next 12 months. Also, even when unemployment does actually rise and the economy slows down, it doesn't always have such a negative effect on the housing market as we might expect. House prices rose throughout the 2010s, despite very weak real wage growth. It may seem counterintuitive, but wealth played a big role. Also, a big driver was the ultra low interest rates, which of course made it cheap to buy on a mortgage. However, this optimistic take on the housing market will need to see inflation actually fall from its current level, rather than just relying on forecasts and expectations that it will. But I would stick my neck out and say that inflation will fall in the coming months. This graph shows two things: input inflation and output price inflation. The input prices is the cost of raw materials, things like crude oil and food, and this inflation rate is only 0.8% in the past 12 months. That big drop, by the way, was driven by cheaper crude oil, though food inflation, of course, does remain quite high. But generally, if this input inflation remains low, you would expect it to feed through into lower headline inflation, at least at some point. So the bad news is that the economy is slowing. And the good news is that the economy is slowing so that we can cut interest rates, and at least some people who have a mortgage will see a small decline in mortgage payments. Now, whilst rates may well fall by the end of the year, how far will they actually fall? Now, usually you would expect interest rates to be around 1-2% above inflation. So if we did see inflation fall to that target of 2%, you might expect interest rates of, say, 3 or 3.5%, which does suggest very little room for any significant rate cuts. However, it is worth pointing out that ECB have already reduced their deposit rate to 2%, which suggests that the old era of ultra-low interest rates we saw in the 2010s could actually return. And if the UK enters into another kind of long-term economic stagnation like the 2010s, then it is quite possible we will follow suit with big rate cuts. Now, of course, this is problematic itself because ultra-low interest rates can distort aspects of the economy, can cause a boom in house prices, and some groups will be better off, some will be worse off. So hopefully it won't come to that. Perhaps, out of a hat, the Chancellor will be able to pull a magic rabbit, which will return confidence, optimism and hope to the UK economy. Tax cuts for all, more investment, a kind of return to the growth that characterised the post-war period. Now, as you know, I do like to finish on a positive note, but I think even the greatest optimist would feel that this is stretching credulity to its farthest stage. At least within the constraints of the current economic worldview, it really is hard to see anything other than significant tax rises falling in areas which will have at least some negative effect on economic growth. But I think the best that we can hope for is somehow an end to the uncertainty about taxes going up, and if this can be created more stability, more confidence, more certainty, then maybe firms will gain some confidence to invest and increase economic growth. Anyway, thanks for watching. Do subscribe and see you soon.